Buffett is selling off all his U.S. stocks, taking action to express his concerns about the American market. He once vowed never to short his own country, but now, at the age of 94, he's going against his former beliefs, leading many to speculate, has he discovered some hidden secret? Buffett's current cash reserves have reached an all-time high in his career, nearing $300 billion, equivalent to about 2 trillion renminbi. This staggering number shows his heightened alertness to future market uncertainties. He not only significantly reduced his holdings in his favorite tech giant, Apple, but also completely sold off his shares in Johnson & Johnson and Procter & Gamble last year, companies he had invested in for over 18 years. Such decisive moves suggest a deep concern about the future. What's even more striking is that his actions go beyond this. Bank of America, a longtime favorite in Buffett's portfolio, has been one of his heavily invested stocks. However, starting in July this year, Buffett reduced his holdings in Bank of America for 12 consecutive trading days, cashing out a total of $3.8 billion. On the first day of September, he again sold off all his remaining shares without hesitation. This series of moves sent shockwaves through Wall Street, as Bank of America has long been a core part of Buffett's investment portfolio. Why would he withdraw so decisively? Looking back at Buffett's investment history, we find that whenever he chose to exit the market, he was never wrong. This is why the industry honors him as the Oracle of Omaha. In May 1969, he dissolved his company, and within a year, the Dow Jones and S&P 500 indices both plunged by 35%. Similarly, just before Black Monday in 1987, he almost prophetically exited nearly all his stocks. 2 months later, the S&P 500 and Dow Jones indices plummeted by 33% and 36%, respectively, with the entire market in panic. In 1999, when the internet bubble led countless investors astray, Buffett remained calm and publicly bet against U.S. tech stocks. His bearish stance was ridiculed at the time, but over the next 2.5 years, the Nasdaq index crashed by 78%, the bubble burst, and the market's prosperity vanished instantly. Buffett's foresight was once again proven correct. In 2007, Buffett again demonstrated his extraordinary foresight. When the shadow of the subprime crisis was just beginning to loom over Wall Street, he had already significantly reduced his U.S. stock positions. Sure enough, when the crisis fully erupted, the Nasdaq and S&P 500 indices both plummeted by 55%. Unlike ordinary investors, Buffett always finds opportunities amid market panic, like a hunter searching for bargains when global markets are down. This time, not only did he accumulate massive wealth, but he also surpassed Bill Gates to become the world's richest person for the first time. Every move Buffett makes seems to manipulate the pulse of the market. Whenever he goes bearish, many Wall Street giants come out to oppose him, but history repeatedly proves that while many can make big money in the stock market, only the Oracle of Omaha manages to exit safely. At the shareholders' meeting in May this year, Buffett publicly expressed his biggest worry: the current U.S. economic boom might be just an illusion, hiding deep internal conflicts and problems that fundamentally contradict economic principles. In simple terms, he likened the U.S. economy to a Ponzi scheme, similar to past bubble internet financial companies and property giants like China's Evergrande. Behind the apparent glory, there is a looming crisis. This economic boom, as Buffett said, is built on creating false appearances that require continuous cash injections to sustain. Over time, the scale of this boom grows larger, while the underlying issues and risks accumulate until it reaches a breaking point and collapses overnight. Evergrande is a prime example, a once globally renowned property giant that crumbled in an instant. This phenomenon is not uncommon in stock markets, especially in Hong Kong and the U.S., where extreme rises and falls are frequent. A stock may rise for 3 to 5 years, increasing tenfold, but can also suddenly plunge by over 90% in a single day. This shows that sometimes market booms are just illusions that vanish when the bubble bursts. Today's America may be facing a similar dilemma. Behind the false prosperity lies a frenzy of debt expansion and economic instability. Since the 2008 financial crisis, global central banks have launched massive quantitative easing policies. Interest rates have been pushed to historic lows, even entering negative territory. While these extremely loose monetary policies temporarily eased economic pressure, they also planted the seeds of asset bubbles for the future. Corporate, government, and household debt have ballooned, trapping the global economy in a cycle of debt dependence. The global debt level has now reached $313 trillion, equivalent to 3 times the global GDP. This isn't just an inflation of numbers, it's an unsettling factor for the global economic system. When Buffett chooses to sell off his U.S. stocks and increase his cash reserves at this time, we must acknowledge that he may have detected warning signs that we cannot yet see. Time will tell, but perhaps the next economic storm is already brewing, and each of Buffett's actions is a prediction and preparation for what lies ahead. If Standard & Poor's were to rate the global economy, it would be downgraded below junk status. This isn't just fearmongering, it's a grim assessment of the current state of the global economy. As the world's largest economy, the U.S.'s fiscal policies and debt expansion directly impact global financial markets. Currently, U.S. national debt accounts for 44% of the global bond market, a 16% increase from the 28% share during the 2008 financial crisis. This indicates that America's debt problem is not just a national crisis but a potential time bomb for the global financial system. Even more alarming is that the U.S. government borrows about $1 trillion every 100 days. This borrowing speed is staggering. The ballooning U.S. debt burden threatens not only the American economy but also keeps global markets on edge. Imagine if the U.S. economy enters a recession or if the global dominance of the dollar is challenged, the risk of the U.S. government defaulting on its debt would skyrocket. This scenario isn't just a national problem but could trigger an unprecedented global economic crisis, possibly the worst in history. To address this situation, the Federal Reserve has adopted quantitative easing policies, pumping massive amounts of money into the economy to stimulate apparent growth. At first glance, it seems like Americans have more cash in hand, and the economy appears robust. However, the risks behind this are significant. The flood of currency does not truly enhance purchasing power. For example, if the Federal Reserve injects $3 trillion into the market in 1 year, it may cause stock market returns to soar temporarily to 10%. However, as money supply increases, inflation might also rise, even reaching 20%. This inflation erodes the real purchasing power of cash. In other words, while it appears that wealth is growing, Americans' actual wealth is shrinking. The U.S. government's intention is to use massive funds to boost manufacturing, ensure employment, and drive economic growth. However, the reality deviates from this goal. Most funds have not flowed into the real economy but into the stock and financial markets. As a result, the financial market's prosperity looks lively, but it's a false prosperity. It's not based on real economic growth but on the inflation of financial bubbles. Once the bubble bursts, the consequences will be severe. According to the Bureau of Economic Analysis, financial assets now make up 63% of average American household wealth. This means most Americans tie their wealth to the stock market rather than saving it in banks or investing in the real economy. This situation has fundamentally changed the economic structure of American society. People's wealth and fortunes are directly affected by stock market fluctuations, making the U.S. stock market an extremely volatile economic factor. When people realize they can earn more than 20% returns with a certain amount of capital in the stock market, many lose interest in working in the real economy, weakening their motivation to work hard. For capitalists, they prefer to invest their money in the stock market and other financial activities to seek quick profits. Imagine earning only 5% profit annually in manufacturing, while a simple stock market investment yields much higher returns. In this situation, who would want to invest in real businesses? This has led to the gradual hollowing out of American industry, with less focus on production and innovation and more on financial gains. Boeing is a prime example of this phenomenon. Once a symbol of American strength and a century-old aircraft manufacturing giant, Boeing is now struggling to survive. This year, Boeing has faced frequent safety issues like emergency door malfunctions, jammed pedals, and engine fires, severely shaking public trust. These crises didn't emerge suddenly but are the result of long-term accumulation, reflecting the financialization and hollowing out trend of American manufacturing. Boeing's decline is directly related to its executive incentive system. In recent years, Boeing's executives have prioritized stock price growth as their main goal, with over 50% of executive compensation tied to stock performance. When all executives focus on stock prices, they may see short-term gains, but the company's fundamentals are neglected. Profits are not reinvested in product development or quality improvements but are instead used for stock buybacks or pleasing Wall Street. This short-term behavior may benefit the company and investors in the short run, but it deteriorates the company's fundamentals in the long term. For instance, Boeing's executives continuously use stock buybacks, bribes, or regulatory manipulation to push stock prices higher. In the short term, this benefits executives and investors, creating a seemingly win-win situation. But this phenomenon is, in fact, destroying the company's manufacturing foundation and reputation. This ultimately leads to increased accidents, as reflected in recent incidents, showing that the entire American economic system is facing a bubble and a hollowing out crisis. Buffett is not just reducing his investments due to concerns about individual companies like Boeing. He may have spotted these broader issues within the American economic framework. The U.S. economy's core problem isn't just the imbalance between finance and the real economy but also the over-reliance on dollar hegemony. Many countries, including China and Russia, have started reducing their dollar reserves and moving away from dollar transactions in their international trade. This signals a global shift, which is a warning sign for the U.S. economy. The dollar's dominance in international trade and reserves has long been the backbone of American economic strength. However, if more countries adopt alternative systems or currencies, the dollar's influence will decline, leading to financial turbulence in the U.S. In conclusion, Buffett's recent moves could be a warning that the U.S. economic bubble is nearing its bursting point. With growing global debt, financialization, and signs of economic instability, it's crucial for investors to heed these signals and act accordingly. The Oracle of Omaha has spoken, now it's up to the market to listen. Thanks for watching. If you enjoyed this video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. See you in the next one.